thought it would be interesting to take a look and share with the viewers our look at 2021 and some of the things that we reflected on that we got right and some of the things we got wrong, and talk about sort of what we learned from those things and how they shape our investment philosophy. Because at the end of the day, it's a very fluid investment process we have, and we learn a lot and we make a lot of mistakes, which are good. We try not to make the same mistake, but a lot of the mistakes we make are learnable or teachable moments. Mike, let's start off with some of the hits. I think we have two in particular we'd like to focus on. The first one is the TINA call, which we made back early in 2021. And as we've stated multiple times throughout the year in our videos, there is still no alternative to stocks. Bonds are more expensive, cash is more expensive, and so there still is no alternative. And until we see one, there's going to be demand, right?
Mm-hmm. Yeah, I mean, any traditional valuation metric for stocks in a vacuum says they're extremely expensive, but they're actually far cheaper than the alternative. And that's because interest rates are at record lows. And central banks aren't even thinking about raising rates. Super important for the year because overall for clients is generally a pretty good year. And for most clients, we stayed overweight equity pretty much the entire year. And there were plenty of reasons throughout the year why you could have gotten scared into going back to neutral equity or underweight equity or whatever the case may be. But TINA was dominant. There is no alternative. And this is something we said would be a key theme throughout the year, that, interest rates are so low. Long-term bonds, if you buy them, if interest rates go nowhere, you make next to nothing. And if interest rates go up, you lose money. Cash, you make nothing. And earnings yields look far more attractive. So that was like the primary filter throughout the year. A lot of things happened this year that if TINA didn't exist, they would have mattered a lot to equities. But with TINA as strong as it was, there may be a speed bump.
Yeah, and as we look back at that, it looks like it was an easy call just because of how things played out. But as you're in the moment, it's never an easy call. As you see things trending, you have to sort of look at the current data and project forward how things will move. And thankfully, we stayed with the overweight to equities throughout the year because it did pay off for our clients. In terms of TINA going forward, what do we think about TINA as we enter 2022?
Yeah, TINA is something we are monitoring very closely, and it looks like in 2022 there is a very high probability that TINA stays as strong as it is, or maybe even gets a little stronger. It is a key theme in our outlook. In our bear case scenario, TINA sort of goes away, or is weakened dramatically. And so that would mean bad things for equities. So in our base case and our bull case, which together represent 80% combined probability, TINA holds true.
All right, let's go on to our next, I guess, I'll call it, maybe we can debate this semi hit that we had last year. It was the call on inflation. We did call inflation, and we didn't call it as high as we got, but we did make the call, and let's reflect on that call. So take us back to that early 2021 call there.
It was sort of a known coming into the year that we were going to get some type of an inflationary spike somewhere around mid 2021, primarily a result of just really easy to beat year-over-year comparisons in terms of prices of goods. I mean, when the economy shut down last spring, goods prices generally fell, and now here we are trying to reopen the economy aggressively, and there is tremendous amount of demand, and demand is spiking, and it's kind of hard to reopen the economy. It's actually harder to reopen it than it is to shut it down completely. Mm-hmm. And so what you're going to see is a big spike in inflation. And that was the known. Going into the year, the consensus was that core CPI was going to be about 2% by the end of 2021. And of course, now we know it was like 5%. So one of the biggest consensus misses in inflation that we've seen, since we've been tracking consensus data. So ultimately, the call was in March that, hey, there's going to be a spike, an inflationary spike, because of how rapidly we're trying to reopen the economy and how many issues there are with rapidly reopening the economy in terms of labor shortages, supply chain issues, et cetera. And so our call was, hey, there's going to be a big spike. And of course, that ultimately happened. By the end of the year, it may cool slightly, but probably not going to cool as dramatically as the market is thinking. And our view was that inflationary pressures were going to be with us for the rest of the year. And so we basically called the trajectory of inflation about right. Once again, as you said, easy to see in hindsight, right? But in the moment, when we haven't seen a strong inflation print in like 12 years or something, right?
Right.
It was very, very difficult to see. We were kind of putting ourselves out there.
Yeah, and I think a couple of the elements of this or variations of this that I think we could have done better at getting right, where we're reacting to the investment element of it, getting into these inflationary commodities faster than we did. I think the fact that we hadn't experienced this inflation made us a little hesitant to really go in and over allocate to inflation sensitive assets right away. Now we eventually did get there, but uh, the process and what we learned is being able to execute quicker when these types of things appear to us. And then secondly, looking at the signs that led to this acceleration in inflation and making sure that we had the right data in front of us. We could have probably been a little bit more proactive in calling it a little earlier and getting ahead of the game. So we did learn a lot about reading the tea leaves of inflation. And so going forward, I think we have a much better lens to view inflationary pressures and what to look for when changing our investment thesis around inflation. All right, so let's do a couple of, I guess, misses, which to me are really more about how we interpreted people's reactions to things. So let's the first, I think, I'm not sure, this was probably around April-ish when we talked about the Fed rate hikes.
And the consensus is that by the end of 2022, we will have recovered all the jobs lost. So you think if you're the Fed, once we've recovered all the jobs lost, that's when a prior Fed might start to think about raising rates, taking the punch bowl away. But this Fed, in our view, is going to take a far more holistic view of employment and not just say, all right, we've recovered from the COVID job losses, pat ourselves on the back, let's raise rates. They're going to look at things like underemployment. They're going to look at things like employment across different racial and socioeconomic breakpoints throughout the economy. And they're going to think, well, actually, we should start hiking rates when employment gets back to trend, which could be very far off. So the Fed is going to have a litany of reasons to not hike rates, not think about raising rates, even after the job market has fully recovered from the COVID losses. So at this point, we already had the narrative about inflation, which is ultimately played out correctly. So this was about how is the Fed going to react to inflation and the labor market. And our view here, ultimately, what I ended up saying on video was that the Fed might not do the first rate hike until the end of 2023 because they at that point had said they are going to look through any spike in inflation tied to the reopening of the economy and not hike interest rates too quickly for the sake of the labor market, which the labor market, back in April, May, was an absolute mess. I mean, it's still a mess, but a different type of mess, I guess you could say. But there was a lot of inequity in the recovery of the labor market, and the Fed had talked about how they were going to take a holistic approach. And so ultimately, we thought the Fed would ignore a lot of the inflationary pressures that we thought were going to build. And ultimately, they did not. They started pivoting right about in May, June, and started reacting to inflation, even though the labor market recovery for much of last year was sluggish, very sluggish. So they actually reacted to inflation despite what was going on in the labor market. And that had a lot of implications for things like the yield curve and the type of equities that did well, but not having their reaction function dialed in. That was a miss.
Right. Well, and technically, to be fair, we haven't missed yet because they haven't they haven't actually raised rates yet. So it could be 2023. However, I think what we're saying is the market reaction to um, the Fed narrative around raising rates in 2022 is really where we missed.
Yeah.
All right. So another reaction function relative to the Delta wave. This was middle of the year. Take us through what we had predicted there.
Vaccines are effective. In the US, over 90% of the 65 and older population has been vaccinated. Therefore, lockdowns should not be necessary. Lockdowns were to prevent overwhelming the healthcare system, and it appears as though the US, economies like the UK, have broken the link between cases, hospitalizations, and deaths. Lockdown should not be necessary in the US, and Delta should not derail the economic recovery.
Yeah, and once again, saying a miss, I don't know, maybe a foul ball. It's like we kind of made contact, I guess, if we're going to go with a baseball analogy here. But so the idea was, as the Delta wave was coming, was the overwhelming majority of the at-risk population in terms of age cohort for COVID had received at least one vaccine dose. And we were following the UK, who dealt with the Delta wave earlier, and they did not impose any strict lockdowns because they said, hey, we've effectively broken the link between case counts and hospitalizations, and so lockdowns are not necessary. Our reaction function has changed now. We're going to open up the economy, and we're going to push vaccinations. That's going to be our go-to reaction function. And so we thought that basically set the stage for a similar type of reaction in the US. And that was somewhat true, somewhat not true. Obviously, we didn't have any shelter-in-place orders. It was not at all like March 2020, right, or April 2020. It was far more open than that. But there was a lot of voluntary social distancing. There were the fact that in the U.S. policies are far more, state and local. There were a lot of policymakers in the U.S. that reacted to case counts just like they would have in April 2020, right? And so that did have an impact on the type of stocks that did well in the market, and that was a miss as well.
Yeah, and we have lots of other hits and misses, and we're happy to always talk about those with our clients because we just want to get better at this every day, and it's I think it humbles us to go through this process every day to see the things we're predicting or investing towards, and to see where we can always do better. So a lot of this noise that's around this past year was a great learning experience for us. I think we got more experience in the last 24 months than probably the last 10 years in terms of everything going on. It seems like things move faster, and we have to really be more nimble in reading the information and improving our investment execution around the information. So we look forward to continuing to learn and to do better for our clients.